What's good, guys? Welcome back to the channel. And in today's video I want to show you how you can simplify internal and external liquidity and how you can use that to frame trade setups without learning any models by heart, by just understanding the logic of price. And yeah, as you can see, we have opened up here the CAD yen chart, but it doesn't really matter what time frame or what pair, it works on all assets. I will also show you guys later on a few examples of how I use that in my recent trades, and also some trades I have posted in the last week's video, I think, or the one before. But what do we have here? So first of all, what can we identify here? We have the Monday range, right? And if we go back, we have the Monday range forming after the Monday daily close, price consolidating, and then it's approaching the Monday range lows. Monday range lows taken out here the first time. So that's the initial low price is creating once we take out the Monday range low. Keep in mind, order flow is still bearish here on the hourly and also on the M15. So now what do we see? By the way, if you want to know how you can use the Monday range to frame trade setups, then you can watch the video in the right corner right here. But now back to the actual topic. We take out the Monday range low, which is external liquidity. We have Monday range low, Monday range high. So external range high, external range low. Now, what happens here? Why do you don't want to long this here now with your stop here? Because all the early longs, which pile in on this retracement here, they probably trail their stop below that recent swing low here. So this becomes a high probability short-term drawn liquidity to take out. So price is retracing into that dealing range. Right? We have dealing range high, dealing range low. We are retracing, more longs are piling in, and then you can see how price is pushing lower again. Now all the longs who piled in on that move up, on that retracement, and the stops below that low here, getting stopped out. So we now have taken out the external liquidity of that dealing range, which took out the liquidity of that dealing range, right? And now it's the time to check if we actually can get now the true reversal. What we initially want to see now is a close above this down close candle, and then also above this fair value gap here. So let's see what price is doing. We close above this down close candle, so we have now a bullish OB here. This down close candle is the bullish order block. We close above this swing high, so that's the so-called market structure break. And we also invert this bearish fair value gap. So we have a bearish inverse fair value gap here, which also lines up with the low of the previous week's range. Now, if you anticipate price to take out now the Monday range highs, obviously before you take any Monday range trade, you always want to have a bias accordingly and a narrative. But let's assume we have that in place now. And you want to frame now longs into the Monday range highs. Now the question is, how do we get into longs here while having still a proper risk reward? Now, first of all, at this point, we have to wait until a new dealing range is forming, right? We need a swing high and a swing low to have a dealing range to then work with and frame a trading setup. So, as you can see, we have already formed a swing low for a dealing range low, and now we want to wait for a dealing range high to form. So we need to wait until an M15 swing high is forming. So let's see if price is forming now an M15 swing high. And as you can see here, we formed a swing high on the M15, right? Now we have this dealing range low, dealing range high, and we aiming now for the external liquidity of that dealing range, right? The Monday range high. We took out the range lows, then we took out the highs of that dealing range, and now we want to aim for that dealing range high here. Now, how do we frame a setup here? And now, this is what I want to teach you about external and internal. Price creates the external liquidity of the dealing range, this high here. And on the initial retracement, it's engineering a weak low. Now, what most people do, or a pretty common mistake, if we have this pattern here and they want to long into the Monday range high, what do? They see this large move up and then they see the retracement. And because their trading is based usually around FOMO and fear and greed, they enter buys on that initial retracement. So they long on this retracement because they are afraid price is running up without them, right? So they long here and then they put their stop, let's say somewhere around here, it doesn't really matter, but they long here and then they aim for the Monday range high, something like that, right? And then they see, okay, price is running, it's pushing higher, it's looking good. And now price apparently made a new higher high, which is true. It made a new higher high. So according to traditional market structure, we now made a higher high, we have a higher low here, so price should now protect this low and then go for the Monday high. So what most people do again, they trail their stop below that low. Or if they may be longed in that up move here somewhere, they also then move their stop here because with a higher high, so price should not retrace below that low. Now again, we always want to think of, okay, where is liquidity resting? Where do we have trapped buyers and trapped sellers? And in this case, what happens here? Let's go to the M15 again. Remember, we have the external dealing range high here, which we just swept, and we engineered this weak low on the initial retracement. So in this case, that's now your internal liquidity pool. Now, if we check how the H1 candle closed, you can see we swept that high, and we also closed inside the range of the previous hourly candle. Meaning everyone who longed now in that leg here I just outlined is now trapped if price is reversing. Where's now the most amount of liquidity resting? Ask yourself now, if price wants to go for that high and it wants to run as many stops as possible on the way up there, where would price go first before it goes for that Monday range external high? Exactly, below that low. So what do you want to wait for? You want to wait for price to run this low. Remember this M15 inverse value gap, which we also have right below as a key level. That's where you want to look for longs. You wait for price to run the low, and then that's your key level with the stop run, which we always use in each trade. You can see on my channel, it's always a stop run into the key level in alignment of the higher time frame order flow with the proper bias and narrative, and under the premise of high probability trading conditions, and then a proper entry, a proper invalidation, and that's your setup. And that's basically the 4-step protocol. First step, trading conditions. Second step, the bias. Then the narrative, which gives you the key level. And then you have the entry and the trade management. And that's why I created a 4-step protocol in that way. You have one system which is teaching you the logic of how price is moving, and you don't need one single model. You have one universal model, so to say, which allows you to frame all trades because you understand the logic of price. It's always lower time frame stop runs into higher time frame key levels in alignment of the overall high time frame order flow under the premise of high probability trading conditions and the overall context, which is the higher time frame narrative. Now, in this case, how do you enter the trade? Again, in the 4-step protocol, there are always 2 trades you can use, 2 trade entries. Either the higher time frame turtle soup entry or the lower time frame confirmation. In this case, you could use the turtle soup entry. Why? Because you have entry here. The invalidation would be the range lows. That's the invalidation, right? The external dealing range low, strong low here. And the TP would be the Monday range high. Now, if we check the risk to reward, we can see it's about 1R, which is obviously not that high. So in this case, I would avoid the turtle soup entry and I would wait for a lower time frame confirmation. Now on exotics, I wouldn't go below the M15, so I would wait for an M15 confirmation and not an M5. On the hourly, on the majors, you can use the M5, but on exotics, I would not go below the M15 from my personal experience. Now let's see if price can go from external, so we trapped buyers above that range high. And now let's see if we can continue lower into that weak low and key level, and then look for a setup to form there. As you can see, we tapped now the key level. So we took out that internal dealing range low. Also, it's important always to have the proper time frame alignment, right? You can't use often, let's say that's an M15 dealing range on our dealing range. You can't use like a random M1 low which forms on the way up. You always need to have a proper time frame alignment. In this case, you want to have at least an M5 or an M15 swing low forming on that initial retracement. And then once we take out external, we can aim for that low. Alright, you have to understand that sequence: external, internal, higher time frame, external. Now back to the M15. We have this M15 fair value gap here now, and if you can close above that fair value gap, you can enter on the next candle's open, high, low, close. So let's see if we can close above here with a candle closure on the M15, and then that would confirm a setup. So you can see here, we closed above, so on the next candle, you buy below the opening. So this candle opens up, and the wick here, that's where you market buy and put your stop below the recent strong low, which has taken this week's low liquidity. Entry, stop, and TP the Monday range high for about 2R. Then, as you can see, price continues and takes out the external dealing range liquidity. So you can see it's always the same sequence. Now, if we go back to one of my trades I have taken last week on pound, let's check what actually happened there. So, on pound, I had a long setup on last week Thursday, right? So again, we have a bias which is bullish, and we have a narrative which is priced to take out those equal highs. So let's find the key level on the hourly. We have this inverse value gap closed above. Now price is retracing, so we have an inverse value gap as the higher time frame key level. Now let's go to the M15. We have the London lows here. That's the dealing range low. We have New York range highs here. That's the external range high. What happens here? We have external high, external low, and we leave behind that week low here, which is also the New York session low. Inside, or right at the top of that inverse value gap. And we also have on the buy side those M15 inefficiencies here. So we have Peter area alignment of the sell side and the buy side. Now, as we are trading here a major currency and the time frame alignment is allowing to go to the M5 because the M15 as well as the hourly are both bullish, so we can use the M5 for an entry here as well. We wait now for price to trade below the low. And in this case, you can also take a higher time frame turtle soup entry. Why? Because we have the entry here. The invalidation is the London low, and the TP is that high, or at least that high, right? So we aim for that high, and you can see here, this high is giving about a 2R trade. If you get a bit of a better entry, which I actually had, which was this fair value gap, then you can see you can get even around 2.2, 2.3R trade. So that would be the turtle soup entry. And then if we go to the lower time frames to see if we can scale into that setup on the lower time frames, then we wait for a sweep here of internal. So the London close session, open, low, high, close, right? Open, low, sweep with low into the key level. Now we wait for a close above this down close candle and this bearish order block. And if we get that with displacement, we have confirmation. So what do we do here? We have to close above with displacement. So we enter on the next candle, open, high, low, close. You open up the next candle and you buy the wick as soon as we open up and wick below. And stop below the strong low. Target this high for about 2.5R or this high for 3R. It's up to you. This high is good enough for me. So that was a trade I've taken. And you can see price immediately runs for the targets. But yeah, I hope you learned something new with that video. And as always, leave a like, subscribe to the channel, and leave a comment down below if you learned something new and if you have any other topics you guys want me to cover in future videos. And see you then in the next one.